Hey everyone and welcome. So today we're going to break down a really powerful tool for any trader out there, Keltner Channels. If you've ever found yourself struggling to see through all the market noise to find a clear, solid trend, then this explainer is definitely for you.
I mean, we've all been there, right? You're just staring at a chart, watching prices bounce up, down, and just chop sideways, and you're trying to figure out, where's the real move? Where's the opportunity? It can feel like you're trying to navigate a storm without a compass. Well, guess what? There's a tool designed specifically to help map out that volatility.
And that tool is the Keltner Channel. The best way to think about it is like your own personal weather report for the market. It's an indicator that kind of wraps itself around the price, creating this dynamic channel that helps you see the trend, spot key levels, and even get a heads up when a price move might be getting a little too stretched out.
So here's the game plan. We'll kick things off by looking at where this tool came from, then we'll break down its surprisingly simple anatomy. After that, we'll dive into how to read its signals and actually apply them with some practical trading strategies before we wrap it all up with the most important takeaway.
All right, so first up, where did this thing even come from? Well, it was originally developed by a grain trader named Chester Keltner way back in the 1960s. But the modern version, the one most of us traders use today, was actually updated by the legendary trader Linda Raschke. She was the one who tweaked the formula, swapping out a simple moving average for something more responsive. And that's the version we're going to explore.
Okay, so you might be thinking, wait a minute, isn't this just like Bollinger Bands? And that's a fair question. The key difference really is how they measure volatility. Bollinger Bands use standard deviation, which can sometimes get a little spiky. Keltner Channels, on the other hand, use something called the average true range, or ATR. What does that mean for you? It means you get these much smoother bands that are way better at filtering out all that choppy market noise, helping you focus on the real trend.
All right, let's get into the nitty-gritty. Let's pop the hood and see what this indicator is actually made of. Now, while it might look a little complicated on a chart, it's actually built from just 3 simple lines. First up, you've got the middle line. This is basically an exponential moving average, or EMA. Think of it as the price's center of gravity, its baseline. Then you have the upper and lower bands. These are just calculated by adding and subtracting that average true range, our volatility measure, from that middle line. And that's it. A center line, a ceiling, and a floor. Super simple.
And here it is, live in action on a real chart. You can see how the price, it mostly stays inside this channel, right? That upper band, it often acts like a ceiling, providing resistance. The lower band acts like a floor, providing support. And that middle line, it's like a gravitational pull for the price. Okay, so we know what it's made of. Now for the fun part. How do we actually read what the channel is telling us? This is where it gets really, really powerful. Learning to read these signals is almost like learning the language of the market's own momentum.
Signal number 1, and honestly the most obvious one, is just trend direction. You don't have to guess anymore. The channel itself literally points the way for you.
I mean, it's just so intuitive. If the entire channel is angled up, well, you're in an uptrend. If it's pointing down, you're in a downtrend. And if it's just moving horizontally, nice and flat, the market's probably just chopping around in a range. It's your very first clue about what the market's up to.
All right, signal number 2, those outer bands. Now, these aren't just some static lines you draw on your chart. No way. They're alive. They're constantly moving and adapting to volatility. They create these dynamic zones of support and resistance that flow right along with the price. And this is a big one. The channel is also amazing at giving us clues about when a market might be getting a little stretched. This is where we start talking about overbought and oversold conditions. So when the price pushes all the way up and hits or even pokes through that upper band, that can be a sign the market is overbought and maybe due for a little breather. The exact opposite is true for the lower band. But, and this is a huge but, you have to be careful here. In a really strong trend, the price can just ride the band for a long, long time. So a touch doesn't automatically mean you should hit the reverse button.
All right, theory's great and all, but how do we actually make money with this thing? Let's get super practical. This is where we turn what we see into what we do.
So take a look at these 2 charts side by side. It's really interesting. Notice how the price acts totally different inside the channel depending on the trend. On the left, in the uptrend, see how the price stays mostly in the top half of the channel? It uses that middle line as a springboard. Then on the right, in the downtrend, it lives in the bottom half and treats that same middle line like a ceiling.
And this right here, this is a classic strategy. That middle line becomes your go-to level. When you're in a strong, established trend, one of the highest probability entries can be just waiting patiently for the price to pull back and test that line before you jump in.
Okay, so pullbacks are great, but what about when a brand new, explosive move is about to kick off? Well, that's where trading breakouts comes into play. This is all about catching that moment when the price just explodes out of its range with serious conviction.
Check this out. This is a textbook upside breakout. See how that candle closes completely outside and above the top band? That's not just a little poke. That's a powerful signal that tells you the buyers have just steamrolled the sellers, and a big new uptrend could be getting started.
And of course, it works the exact same way on the downside. It's the mirror image. A solid candle closing firmly below that lower band is your signal that the sellers have taken over completely. This could be the very start of a sharp drop, and the Keltner channel gives you that early warning.
Whew, okay. We have covered a ton of ground. So let's just boil this all down to the most important stuff, the key things you can take away and start using, like, right now.
So if you remember anything, remember this. 1. Use the slope to instantly see the trend. Is it up, down, or flat? 2. For entries in trends, look for those pullbacks to the middle line. 3. Watch for those big, decisive closes outside the bands to catch breakouts. And 4. Always keep an eye on how wide the channel is. When it gets really tight and narrow, it often means a big move is brewing.
You know, there's a great quote from Confucius that I think applies perfectly here. Real knowledge is to know the extent of one's ignorance. The Keltner channel, it's an amazing tool, right? But it's just that, one tool in your toolbox. Real knowledge as a trader means knowing your tools have limits and never, ever relying on just one signal. It's powerful, but it's not a crystal ball.
So, I'll leave you with this final question to chew on. The Keltner channel gives you this fantastic map for volatility and trend. But how could you make it even more robust? Imagine, what would happen if you combined its signals with, say, an oscillator, like the RSI to spot divergence, or maybe a volume indicator to confirm a breakout? Now that is where the real art of trading begins.